NIO stock closed Friday at $6.86, down about 4.1% for the session. At first glance, it looks like another tough day for the company, another painful drop, and another example of Chinese stocks getting hit while the rest of the market struggles to find direction. But here's the strange thing about today's move. Even though the price went down, none of the selling pressure was actually caused by new bad news about NIO. In fact, the more you look into today's price action, the clearer it becomes that the real story isn't what happened to the stock. The real story is what didn't happen. So let's break this down in a calm, measured way, because there's a lot of noise in the market today, especially around Chinese companies and electric vehicle makers. But when you strip that noise away, today's drop becomes a lot less dramatic than it looks at first. First, the broader Nasdaq was down strongly. Tech stocks across the board sold off, and this was the worst week for the Nasdaq since April. When the market goes into a risk-off mood, the first stocks to get sold are the high beta ones, growth names, EV names, and anything that falls into the volatile and speculative category. NIO tends to be grouped in that bucket, even when the company hasn't done anything new to deserve the fear. And today was no exception. As the Nasdaq fell, NIO followed, not because the company slipped up, but because algorithms and funds simply rotated away from risk. On top of that, nearly every major Chinese ADR was down today. Alibaba, PDD, XPeng, Li Auto, they all took hits. This wasn't a NIO-specific move. It was a China-wide de-risking move ahead of the weekend. Hedge funds hate going into a Saturday and Sunday with heavy China exposure because geopolitical headlines can break at any time. A single comment from a US politician, a single tariff rumor, a single new restriction, anything like that can move the market. So what do funds do? They reduce exposure before the weekend. And that's exactly what happened today. When you zoom out, you realize NIO didn't do any worse than the rest of the China sector. In fact, it actually held up a little better than some of its peers. The decline was orderly, not panic-driven. That distinction is important. You didn't see capitulation. You didn't see massive volume spikes. You didn't see institutional outflows. You saw a simple, mechanical de-risking process. Now, let's talk about the lawsuits and the ongoing questions around NIO's accounting. These headlines aren't new. The GIC lawsuit from October has already been absorbed by the market. And importantly, there were no new negative legal developments today. But because the story was quiet this week, no major announcements, no guidance updates, no fresh delivery numbers, these older concerns drifted back into the conversation. But again, this isn't new information. Nothing changed today on that front. The lawsuit is still there, the concerns are still there, and the market had already priced in that risk. So while the headlines might look scary, they had little to do with the drop. They simply get recycled whenever volatility spikes. Another important factor is the behavior of options traders. There was heavy options open interest around the $7 strike price this week. $7 is an important psychological level for NIO. Once the stock dropped below it during the day, it created a small chain reaction. Stop-loss orders were triggered. Market makers hedged their positions by selling shares. Short-term traders piled in to chase the downside. This selling wasn't fundamental, it was mechanical. It was technical. And it wasn't driven by sentiment. It was driven by math. When a stock breaks a key technical level, the algorithms take over. And those algorithms don't care about deliveries, battery swapping, earnings potential, or global expansion. They only care about price. Once price broke, selling accelerated. But here's the key takeaway. This kind of selling stops as soon as the technical conditions reset. It doesn't reflect the long-term outlook of the company. And speaking of long-term outlook, let's take a moment to consider what NIO actually did this week. The answer is, not much, and that's exactly why today's drop shouldn't be misunderstood. NIO didn't release any negative news because there wasn't any. The company didn't warn about lower deliveries. It didn't cut guidance. It didn't announce a delay or a setback. In fact, the fundamentals remain exactly the same as they were earlier this month when the stock traded higher. Record October deliveries are still in place. The 70% ES8 production increase for November is still in place. Growing interest in Onvo and Firefly models is still in place. Battery swapping expansion continues. European rollout continues. Financial improvements remain on the horizon. Literally nothing about the story changed today except for the share price. And when price moves without news, it almost always means the selling isn't about the company, it's about the market. One of the most overlooked details today is the volume. If investors were truly worried about NIO's long-term future, you would have seen a surge in selling volume. You would have seen a breakdown in the order book. But instead, volume was moderate. Not panic. Not capitulation. Not fear. Just steady, routine trading as the market rebalanced. Another overlooked detail is that retail sentiment cooled today. There wasn't a lot of retail buying, but there also wasn't a lot of fear. This kind of neutral sentiment is actually healthier than the extreme swings we saw earlier this year. Neutrality often leads to consolidation, and consolidation is usually followed by a breakout once a catalyst appears. And that's the interesting dynamic right now. NIO doesn't need to fight to stay afloat. It just needs to wait for the next piece of real information, whether that's November deliveries, new model updates, or production news. Those catalysts are coming. And waiting is often harder for investors than reacting. Now let's talk about EV sector sentiment more broadly. This was a down day for Tesla, XPeng, Li Auto, Rivian, and Lucid. The entire sector was red. When EV sentiment worsens, NIO always takes a hit, even when the company-specific story is strong. But that's just part of the cyclical nature of this industry. EV stocks live and die by momentum, and momentum rotates week to week. Today just wasn't a momentum day. But here's where today's move becomes interesting. The fundamentals that matter to NIO investors, things like deliveries, infrastructure, brand expansion, and production efficiency, remain intact. And today's move didn't challenge or weaken any of those pillars. It was a macro-driven dip into what is increasingly looking like a value zone. The stock is now in a price range where long-term investors often start paying attention again. And there's something else worth noting. Stocks that fall on macro news, with no company-specific catalyst, often rebound faster than expected once market conditions improve. They don't need to repair sentiment, because sentiment wasn't actually damaged. They don't need to apologize for bad numbers, because there are no bad numbers. They simply need the macro clouds to clear. NIO has been one of the more stabilized Chinese EV stocks in recent weeks. Even with today's drop, the stock is still within its recent trading range. It hasn't broken down. It hasn't made new lows. It hasn't violated long-term support. It's just drifting with the market, waiting for the next catalyst. So as we head into the weekend, here's the real story. NIO dropped because the market dropped. It dropped because Chinese ADRs dropped. It dropped because risk-off sentiment took over. But it did not drop because NIO did anything wrong. It did not drop because investors lost confidence. And it did not drop because new information changed the long-term outlook. If anything, the lack of panic today suggests something different. It suggests the stock is stabilizing. It suggests investors are comfortable holding through uncertainty. And it suggests that the next meaningful move will come not from fear, but from news. For long-term investors, today isn't a warning sign. It's simply a reminder that markets move in cycles, and a stock like NIO, one with volatility, growth potential, and geopolitical exposure, will always react more to macro noise than most people expect. But the fundamentals remain. The strategy remains. And the catalysts remain. And that's the part of the story that matters far more than a 4% drop driven by a weak Friday session. If you found this breakdown helpful, hit the like button, subscribe for more balanced EV and tech stock analysis, and let me know in the comments whether you think NIO's current trading range is an opportunity or just a pause before the next big move. Thanks for watching, enjoy your weekend, and I'll see you in the next video.